Hey everyone, it's not very often that I make big changes in my portfolio. Most of the time it just stays the same over time. In fact, over the past couple of years, I haven't really made any changes at all. But over the past 2 weeks, I sold down my entire Meta Platforms or Facebook investment, and I moved that money as well as some other cash into a new stock, which is quickly becoming one of, if not the biggest position in my portfolio. And in today's video, I simply want to go through my Facebook investment, which I initially made all the way back in 2018. I want to talk about why I'm selling it now, why I no longer am confident in the business going forward. And I also want to talk about the company or the stock that I'm putting a significant amount of money into and why I'm investing in that business and why I think it's likely to do better than Meta Platforms over time. This video isn't about me telling you to sell your Facebook investment or to buy into this new stock that I'm buying. This video is just for educational purposes. You can see some of the reasoning and rationale behind why I would sell a business that I originally thought was one that is great, why I would sell one of those businesses, and what are the major things that I'm looking for when I'm looking to make a massive investment in a new company. So with that said, if you enjoyed today's video, all I ask in return is that you hit that like button or hit subscribe if you want to stay up to date with content that I post in the future. But with that said, let's jump into the video. So as I mentioned, I invested into Meta Platforms for the first time all the way back in mid 2018. The stock had been on an absolute tear since its IPO for many years. I think it IPO'd in 2012 or around then, and it had really just seen consistent increases in its stock price. And 2018 was the first time that there were some problems going on in the business, and a number of these problems stacked on top of each other, which caused the stock to collapse initially about 20% on its earnings release in the middle of the year, and then the stock continued to fall down a total of 40% through 2018. Some of the issues that were going on were they were facing a number of European Union fines, there was the Cambridge Analytica data breach that went on, and all of these things meant that Facebook came out and said, we're going to be spending a lot more money to make sure we have the highest level of privacy and security for our users' data. And what investors took that as was lower profit margins going forward. But as someone who is a long-term investor, I wasn't particularly concerned about lower profit margins over the next 1, 2, or even 3 years. I'm looking a decade out, so I viewed this as a short-term event and did a valuation on the company to see if I could get it at a price where the price was appropriate relative to the future cash flows of the business. And up until recently, the stock had done extremely well over the course of about 3 years while I held the investment. At its peak, it was about a double. So the stock had doubled over 3 years, which is incredibly impressive. It's much higher than a 15% return, which is what I'm looking for. But all of that doubling in its stock price was erased, most of it in a single day a couple of weeks ago, but certainly over the past couple of weeks, the stock has come down significantly from that price. And there's a number of concerns that have been mounting for Meta Platforms, which seem to all come together in the earnings report and weak guidance that came as a result of that earnings report. Things such as the iOS tracking update that limits the effectiveness of Facebook's advertisements on mobile devices, on iPhone devices, I should say, TikTok taking engagement away from Instagram in particular, and just a number of other things that had been going on in the company, including this EU data transfer issue, whether Facebook is going to continue to be able to move EU data to their US headquarters in order to use it to create effective advertisements. And I knew about all of these things prior to the earnings results, but it actually wasn't any of these things that caused me to kind of change my thinking. The real nail in the coffin for my investment in Meta Platforms was a press release that was made by Google about Android potentially implementing some of the same tracking changes that iOS had earlier in 2021. Facebook relies heavily on, in particular, website and application tracking on mobile devices. Mobile devices are the primary way that people access Facebook's applications now, and tracking people across websites that they use on iPhones and Android devices, and tracking how people use applications and providing advertisements in applications is critical to Facebook's business, far more, in fact, than Google, which generates the vast majority of its revenue through Google search advertising. So while the iOS change earlier in 2021 was a concern, the vast majority of devices that people use are Android devices. So I didn't see it as being a complete impactor on advertiser effectiveness across the board. But if these changes do come to Android, and it's not confirmed or anything, but if they do, it could severely impact the ability of Meta platforms to provide advertising that is just, let's say, equally as good as Google's platforms. Now, I want to be clear, me selling Meta platforms doesn't mean that I think the stock is going to go down or that it's necessarily going to be a bad performer. I'm not shorting the stock. I'm not betting against it, betting that it's going to go down. These changes, along with a number of other things going on in the business, just mean that I no longer feel confident that I can reasonably project forward the future cash flows of the business. The key reason why I don't invest in the vast majority of businesses is usually because I don't understand the business well enough, or their earnings are not clear enough to me that I can map out the next 10 years and be confident that they will produce an approximate amount of cash flow that I'm expecting. For Facebook, they had a very, very consistent business model, but with these growing concerns, the EU data changes, the iOS change, the Android change, regulation coming down potentially from a number of regions, a number of countries very annoyed at Facebook and looking to regulate them in terms of tax avoidance. There's just so many things that could impact their consistency of profitability over time, and that's the reason why I no longer want to hold the investment. And then there's one other point of view which I think has less of an impact as some of these other things directly on cash flow, but it is something that I've thought about and had a growing change of belief in regards to Facebook social media platforms. If we just exclude Messenger and WhatsApp for a second and just focus on Instagram, for example, I used to view Instagram as kind of similar to Coca-Cola, that they sold a product that isn't good for you. You know you shouldn't be using social media regularly. You know that you shouldn't drink Coca-Cola all the time. It's not great for you. But I viewed it in the way of Coca-Cola in that it can be a value add in moderation, that it's not something that will, for most people at least, cripple your life drinking Coca-Cola. For the vast majority of people, you can just have it in moderation and it can be a value add to your life. I now kind of think social media is less like Coca-Cola and more like cigarettes, in that the vast majority of people who use social media aggressively are people who were too young when they got onto social media to understand the risks, and now don't really enjoy the amount of time that they spend and feel as though using social media actually extracts from their life. It doesn't actually add anything overall. And I think this has a component in investing as well. I think we should invest in products and services that we believe in, that we have values that are aligned with ours. And I have just had this growing feeling that the values of Facebook don't 100% or even mostly align with my personal values. But I did find an investment that I wanted to move the money into, and it's an investment that I had already put some money into, and I'm going to be continuing to invest in this business beyond just moving my Facebook investment into it, and that stock is Netflix stock. Netflix is probably the most impressive company I've ever come across through all of the investment research that I've done over the past few years. And I had looked at Netflix previously, but its price was exceedingly high that it really wasn't worth doing further digging. It wasn't a business that was anywhere near a price that I would consider starting to add to it. And that kind of changed over the past few weeks. But Netflix's business is also one that's relatively simple. They essentially create and acquire original TV and movie content. They also license content, but primarily they're creating it in their film studios or buying it from other film studios. And then they present it to their subscriber base who pay on a month-by-month basis, meaning that revenue is recurring and extremely smooth and consistent over time. And the competitive advantage that Netflix has over all of the other media and entertainment companies is that they are the only company that is willing to spend every single dollar of economic benefit that they generate on adding value for their subscriber, for their customer base. They by far have the best user interface out of any streaming platform. They typically release their shows all at once, so they give customers the choice of exactly how and how quickly you want to consume the content on their platform. They produce more exclusive streaming content than even all of the larger media companies such as Disney and AT&T. These companies produce more content overall, but in terms of exclusive streaming content, which is the future, Netflix is beating all of them. And it's not only a matter of quantity, in terms of quality, they produce the best TV and movie series out of all of the media companies by a number of standards. Particularly when it comes to their television series, they are leading the way in awards and also which shows people are watching the most. Last year, Netflix shows won the most Emmys for the first time, crushing HBO and every other film studio. And according to Nielsen, of the top 10 most watched TV series in 2020, Netflix owned all 10 of them. They also don't lock subscribers in for more than a month. They don't offer a discount if you lock yourself in for a year. And even with that, they have a month-by-month retention rate of 97.5%, which is incredibly impressive. And if you look at something such as 6-month retention, the only streaming platform that has better retention over a 6-month period is Disney Plus's 12-month subscription plan. So essentially, the only way that Disney Plus keeps people on the platform after 6 months at a higher rate than Netflix is when people actually can't leave because they're locked in for 12 months. And this amazing business is run by an incredible management team led by the founder, Reed Hastings, who is co-CEO with Ted Sarandos, who has also been at Netflix for an extremely long period of time. And one of the key reasons why Netflix has been so good consistently, even as the business has evolved many times from licensing physical DVDs to moving their licensed content onto a streaming platform, to then moving into basically becoming a film and production studio that produces primarily their own original content, one of the key reasons is because the management team is extremely good at hiring. There's actually a number of podcasts and interviews that Reed Hastings has done about what his hiring strategy is and how it's far more effective at weeding out people who shouldn't be working at Netflix and making sure you retain people who should be working there and are doing good work. There's tons of interviews about it. Maybe I will leave a link to one of them down in the description below, and you can check out his thought process and why it's been so successful over a couple of decades. But most importantly, Netflix's success hinges on the idea that they employ a scaled economies shared business model. So first of all, the business has economies of scale, so their expenses are not rising as quickly as their revenue when they're adding new subscribers and increasing the cost of the subscription. So as they scale, as their subscriber base grows, they have incremental dollars that they can decide what to do with. And a lot of businesses, when they achieve economies of scale, they will deliver that extra economic benefit to the shareholders in the form of dividends or share buybacks. What the scaled economies shared business model does is it means that you take every dollar of economic benefit and you return it to the customer either in the form of lower prices or in a better platform and better value for the customer. In this case, Netflix delivers every single dollar that they produce in profit back to customers in the form of more and better content. And what this means is, on the surface level, the business looks like it doesn't produce any profit. If you look at the cash flow statement, it's always negative, and it looks like the business is a terrible business. The same thing was said about Costco in the early days, and even to today, they have terrible profit margins. But the reason why Costco has terrible profit margins isn't because they're an inefficient business. It's not because their expenses are so high and they can't get them down. It's because they lower their prices, which squeezes their margins, but solidifies their economic fortress. And Netflix does a similar thing, not on the pricing side, but on the value creation side, in that every single dollar that they generate, they put it back into creating more content and accelerating the snowball in which their content library grows. This is exactly why Netflix is winning streaming, and it's very likely they will continue to dominate, because while you have these other bigger legacy media companies like Disney and AT&T that own all of these digital assets, all of these content assets, there is not a chance in hell that these businesses will invest or reinvest every single dollar that they make back into streaming content, because they have these other streams that they've built over many, many decades, and investors at this point expect, let's say from AT&T, consistent dividends. They expect cash to be delivered to shareholders, which means they physically can't reinvest money back into the business. They would lose a bunch of shareholders. It would be terrible for their business. And Netflix will just continue to take every extra dollar they make and put it back into content, and they will accelerate their lead and solidify their economic moat in a similar way that Costco has solidified their moat as the discount wholesale consumer goods merchandise business, because they consistently lower prices and everyone knows them for that. So then it's just a question of valuation. Of course, we can't just invest in great businesses. We need to figure out what they're worth. And I'll admit it's very difficult to figure out what Netflix is worth because they're reinvesting every single dollar back into new content. And it's difficult to figure out how much of that content is just necessary spending to maintain the platform, to maintain subscribers, and how much of it is specifically reinvestment by choice to attract new subscribers. But if you look at the risk reward profile of Netflix, I think it is extremely asymmetrical to the upside in that the downside for the business is probably fairly limited with their very, very solid North American business, North American subscriber base that has extremely high retention. And there is this huge open playing field of all of these foreign countries, a lot of them where film needs to be made or should be made in foreign languages, where there is literally no competition to Netflix where they're spending money and making foreign films in places such as Korea, Japan, France, and they're the only Hollywood level business that is making content in those places. And I think they will do extremely well in capturing a large market share in these markets, which are frankly much bigger than North America anyway. The North American paid TV market, I think, was about 60 to 90 million households. Globally, that's closer to 7 to 800 million households. And that's just pay TV households. If you expand it to the number of people with access to the internet in general, it's closer to 1 billion, and it's growing every single day, particularly at a high rate in areas such as India. I'm sure there's a lot of people who probably view Netflix as relatively a speculative, high growth business, but I don't view it that way at all. I think Netflix has done an extremely good job at proving that they have deep competitive advantages in their penetrated markets, such as North America. And they also have this huge opportunity to test that same business model elsewhere. Now, will they succeed at the same rate overseas? Who knows, right? We don't know to what level they will succeed, but I view it in a very similar way to how Nick Sleep looked at Costco in the early 2000s, where they only had a lot of store density in a couple of states, and that was his proven economic model, and he expanded that across the US. What happens if they have this many stores across every state in the US? Or Warren Buffett's investment in Coca-Cola in the 80s, where they had extremely high consumption of Coca-Cola in the US, and they were just starting to build distribution in these foreign countries. And the question again was, hey, they have this amazing economic moat in the US. Will they be able to apply this business model to other countries and expand their business from just being an American business really to a global business? And I think that's where Netflix is right on the cusp of whether they'll be able to do that. We're currently seeing them spend a lot of money on foreign film. We haven't yet seen the payback on that. So that's what we will be looking to see over the next 5 years, whether the billions of dollars they're spending on foreign films in these different regions will generate a significant subscriber base that they can leverage for even more content. So I hope you guys got some value out of today's video. I'd love to hear your thoughts down in the comment section below. And of course, if you want to see more content like this in the future, make sure you hit subscribe. But with that said, hope you guys have a great day. I'll see you in the next one.